Hey everyone, I wanted to go over some macroeconomic data, sentiment, and history in order to better understand where the crypto market is going from here. If you remember from last cycle, the end of the crypto bull run was marked by the increase in interest rates by the Federal Reserve as a result of rising inflation. In March of 2022, the Fed made its first interest rate increase since 2018, raising rates from 0% to half a basis point. This resulted in the depegging of the Terra Luna stablecoin and the collapse of several centralized crypto exchanges and firms, which included FTX, Celsius, and Three Arrows Capital. Since then, the Fed has hiked rates a total of 11 times between March 2022 and January 2024, making borrowing more expensive for banks, businesses, and people in an attempt to curb rampant inflation. This has also reduced the liquidity that parabolic crypto bull runs rely on. In July of 2023, the Fed made its final interest rate increase, bringing rates to around 5.5%. And as of right now, the Fed has ceased raising interest rates in an attempt to prevent a potential future recession. But if history has been correct, the potential for the Fed to orchestrate a soft landing is around 0 to 10%. So the question is, what is the current state of the market and how will the current crypto bull run be affected? So the first thing I want to do is check in on how the average consumer is doing. According to this Harris poll, 56% of Americans currently believe we are in a recession. 55% of those Americans believe the economy is shrinking, and 49% believe that the S&P 500 is down for the year. Meanwhile, GDP data has shown positive GDP growth for 7 straight quarters, and the S&P 500 is up 12% this year, which is an all-new-time high. The poll also says that 49% of Americans believe unemployment is at a 50-year high, though the rate has been under 4%, a near 50-year low. 58% of Americans blame the president for the state of the economy, according to the poll. And according to this article, they are wrong. So, why is there such a huge disconnect between the data and the reality? Setting aside the fact that the average American probably doesn't actively manage their investment portfolio and probably couldn't tell you what the S&P 500 stands for, what they do is go to the grocery store once or twice a week. And according to this chart, the growing cost of a quick trip to the grocery store has increased from $19.65 to $25.83 since 2018. Now, I can tell you that when I go to the grocery store, the prices are actually a lot more expensive because when I go to the grocery store, I spend about at least $100, $120 every time I go, which is about once or twice a week. Now, this is from the Bureau of Labor and Statistics, so this is the official guidance from the United States government and what mainstream media likes to portray. However, the trillion-dollar foreign exchange industry uses the Big Mac price as the ultimate inflation indicator. And the reason why they do this is because it's not adjusted by government statisticians. If you didn't know this, the 1980s CPI calculation would actually show inflation a lot higher than is currently stated. And the reason why the government does this is they adjust prices for hedonistics. And hedonistics is basically how our lifestyles have become better because of improvements in the products that we purchase and in technology in general. So if we look at this chart, a cheeseburger at the end of 2019 was about $1. And by mid 2024, that price has increased to $3.15, which is about 215% increase. If you look at the French fries, a medium French fry was about $1.79, and it has increased to $4.19, which is a 134% increase. And if you're looking at the actual Big Mac, it was about $3.99, and it has since increased to $7.49, which is about an 87.5% increase. So depending on where you live, your prices might differ. I know LA prices are going to be a lot more expensive than where I live in or the rural eastern part of the United States. But it has now become an issue for consumers to go to McDonald's and pay $20 for a meal. You take a family of five, and it's going to be $100, and your money is probably served better going to the grocery store and eating more healthy, or going to a better restaurant for the quality of the food. Taking a look at quality of job outlook, you can see that it has decreased precipitously since 2023. 51% of Americans say it is a bad time to find a quality job, the highest share since April 2021. And since 2022, the share of respondents saying their job situation is getting worse jumped to 25%, according to this Gallup poll. A more concerning statistic is that the percentage of people with delinquent credit card debt has continued to rise. 1 in 6 Americans from the poorest 10% of zip codes are in credit card debt delinquency, according to the Federal Reserve, and the share of people in delinquency in these areas has increased from 11% in quarter 2 2021 to 17% in the first quarter of 2024, and this is the highest in 21 years. In just 10 years, this percentage has more than doubled. Meanwhile, the share of people with delinquent credit card debt nationally is around 12%, and this is the largest since 2003. For 90% of Americans, delinquency rates on credit card debt are now above levels since 2008, which was the great financial crisis. And this statistic really blew me out of the way, and this is one of the reasons why US consumers feel like they are in a recession. Another troubling statistic is that people don't feel like buying homes. And this could be for a variety of reasons, but mostly it's because they can't afford the down payment, they can't afford the interest rate, or they can't afford the high price of housing as it is now. I know that my own house has increased at least 42% since the beginning of 2020. So here it says that home buying conditions have deteriorated significantly, and current levels have only been seen twice since 1960, and both occurred around recessions. Taking a look at mainstream retail stores, Target fell about 8% after reporting weaker than expected earnings, with a 3% revenue decline due to consumer weakness. The CEO said the decline reflects continued soft trends in discretionary categories, and the company's store traffic fell about 1.9% last quarter, and the average amount spent by customers also fell about 1.9%. Consumers bought fewer everyday items like groceries along with fewer discretionary goods, and this is another sign that consumers are struggling. I know for me, I generally like to go to Target. It's an upscale experience compared to going to Walmart. And if you check Walmart's stock, it actually has increased as a result of a lot of consumers coming to get the cheaper prices. The last economic statistic that I want to share with you is that the US federal budget has crossed a grim milestone as interest payments have overtaken defense spending, and this is very bad. For the first 7 months of fiscal year 2024, which began last October, net interest payments totaled about $514 billion, outpacing defense by $20 billion. Budget analysts think that the trend will continue, making 2024 the first year ever that the United States will spend more on interest payments than on national defense. So, what does this indicate? It indicates that at some point, the government's going to have to institute austerity, increase taxes, or it's going to have to figure out how to reduce its interest on its debt. And the way that it's going to do that is getting the Fed to reduce interest rates so that they can again service their debt. So right now, even the Federal Reserve is negative on its balance sheet because it capitalized on a bunch of 2% interest debt and is now handing out 5% interest debt. So that's a negative spread of about 3%, where they lost, I think, about $114 billion so far this year. As you can see, this is how Treasury futures are being positioned right now. Hedge funds have now built the largest 10-year Treasury short position in history, while asset managers have built the largest long position. And the reason why they're doing this is because leverage funds are expecting sticky inflation. So what does all this information mean as a trader and investor? Well, I'm not necessarily trying to time the market, but what I am trying to do is to identify where in the business and economic cycle we are at in order to identify the dangers and how to better place my trades and make better decisions. If you take a look at this chart, this is the 1966 versus 2022 analog of the S&P 500. And usually history is a good predictor of future outcome. So the pink line is the 1966 S&P 500 line, and it's basically what is the conditions that are most similar to where we are right now. Now, they're never the same, but they're close enough. And what generally happens, the black line being the 2022 analog, is that before we have a recession, as the market is beginning to fall apart, so to speak, you generally have more upside than downside. And the indicator of downside is actually when the Federal Reserve starts to decrease interest rates. The only time that the Federal Reserve ever decreases interest rates is when it has finally broken something. And this is the exact same thing that happened back in 2021, 2022, when the crypto market began its downturn and all of those exchanges ended up collapsing with their Ponzonomics. So my prediction as of right now is that we have at least another 20% in rise for the S&P 500 and the broader economy. And as far as crypto is concerned, it's going to continue to rise as well in a parabolic manner. I think we're going to get that blow off top sometime at the end of summer, and then at the beginning of fall, that's when things are going to become more dangerous and when I'm going to probably start taking some of my profits. And this is actually backed up by smart money, which is now betting long on the market. And every time this indicator is at a low level, the S&P 500 still has more upside, and this time really should be no different. So this is the S&P 500 and the OEX, open interest rate ratio. And what it is showing is that smart money is buying. So that is what I'm going to be doing as well. And then as we approach the fall and as the FOMC provides guidance, I'm going to be a little bit more vigilant, and I'm going to be looking to start taking profit. Now, this is just what I see as of right now. Conditions could change as the time goes by, but as of right now, I think we are in a good position. We just need to be vigilant of the current market cycle, and we can go from here. If you have made it this far and have gained some insightful knowledge about the markets and what to do with your investments, please hit that like and subscribe button. I hope you have a great day, and if you have any requests for technical analysis, please send it my way, or any other things that you would like to know about the economy, markets, crypto, and the business cycle. All right, thanks. Bye.